Welcome back. Last part of adjustments, part 3. We're going to do the adjusting journal entries for accruals. We're going to book 3 journal entries. We want to do this to make sure that we recognize all the revenue earned or recognize all the expenses incurred during the accounting period that we're reporting on that wouldn't have already been picked up through daily entries. Most commonly, adjusting journal entry for revenue recorded before cash is received most commonly is for services performed. Somebody comes into the room and says, hey, we finished those posters early, we finished those brochures early, we finished that work early, and we need to recognize the revenue even if we haven't billed it. So we've earned it. That's the test. There are other types of accruals, interest revenue, rent revenue, but we're going to talk just about service revenue today. This adjusting journal entry serves 2 purposes. It properly shows accounts receivable with the correct balance, and it properly records all the revenue that we've earned. Let's take the number 5, adjustment number 5. Again, somebody says, hey, I know we got all the bills out, but there's one more bill we didn't get out in time. But however, we have completed the work, so we need to recognize the revenue. So we're going to increase accounts receivable, it's an asset, and increase service revenue, it's a revenue account with a credit. What have we done here? We've properly stated accounts receivable as $7,000. If we didn't book this journal entry, we would have understated accounts receivable. Service revenue, we've increased it by $2,300. Again, if we didn't book this entry, we would have understated it. So, reasons for adjustment: the revenue was earned but not yet received in cash or recorded. If we didn't do this, assets would be understated, revenues would be also understated. Now we're going to do 2 accrued expenses. There are more. The 2 we're going to do have to do with interest expense and salaries expense. Examples of other ones could be tax expenses owed or rent expenses owed, but not yet paid or in cash or even recorded. So what are we trying to accomplish with accrued expenses? We're trying to say we want to make sure we record all our obligations, our liabilities, and we record and recognize all of our expenses. So again, 1 balance sheet account at least, 1 income statement account. All adjusting journal entries will affect at least 1 balance sheet account and 1 income statement account. Adjustment number 6. Remember, Emerald City Design last paid its administrative assistant on January 29th. He was paid for 4 weeks, and he receives total salaries of $3,600 every 4 weeks. He works a 5-day work week, or this works out to $180 a day. Therefore, his accrued salaries for the 2 days that we haven't paid him as of January 31st, we owe him $360. Emerald City Design owes him $360. Now, of course, he'll be paid for these 2 days on the next payroll, February 28th. But if we're going to report our financials as of January 31st, we have to recognize these 2 days that we owe him for, but that he has not been paid for. So to accrue this, we're going to debit salary expense for the 2 days and credit salary payable. So what have we done? Salary expense properly reflects all the money he's earned in January, and salary payable shows what he's earned but we haven't paid him for yet. 1 income statement account, 1 balance sheet account. Last adjustment we're going to discuss has to do with interest. Remember, Emerald City signed a 3-month note payable for $5,000. Emerald City took the cash and recognized the note payable. How do we calculate the interest that we owe as of January 31st. And we're going to calculate it from January 1st. We're not going to try and figure out the 4 days there, 4 or 5 days there. All right. To calculate this interest of $50, you take the principal, $5,000, you multiply it by the annual interest rate, and because it's only for 1 month, you divide it by 12, which equals $50. So annual interest, $5,000 times 12%, annual interest would be $600. Monthly interest is $50. So we're not going to pay this interest until the note comes due in 3 months. But at the end of January, we owe $50 in interest. Interest debit, interest expense, and income statement account, credit interest payable. If we didn't do these adjusting journal entries, we would understate expenses, and we would also understate liabilities. So we have to book it to the expense account and the liability account. Never book an entry to debit, expense, credit, liability. You always want to list the very specific accounts. Here they are. You can see them listed in green. I've got new totals on my T accounts, and this is really the final accounts for the period. So here we have the asset accounts, liabilities, and stockholders' equity, service revenue, and all the expense accounts. We'll transfer all of these account balances and create our adjusted trial balance. And its purpose is to prove the equality of the debit balances and credit balances, and it also serves as the source for the final financial statements. Now I want to draw your attention again to, I've got a couple accounts listed with 0 balances. Normally you would just leave those off. Now please note that retained earnings has a 0 balance. That won't last for long because it will get a new balance in Chapter 4. But let's publish our financial statements. First statement, always income statement, then retained earnings, and then the balance sheet. And here it is. Total revenue at the top of the income statement, then a list of all the expense accounts. Total expenses, see how it's shown as a positive? And then net income as a positive. If you had a net loss, it would be in brackets, in parentheses, negative, showing a negative. You need this number because it transfers over to the statement of retained earnings. This is Emerald City's first month of business, so it has a 0 balance. Then we add net income, subtract out the dividends, and now we have an ending balance in retained earnings. We publish our final balance sheet with all of our final balances. Please note that the cash, accounts receivable, supplies, prepaids are listed before equipment and its associated accumulated depreciation account. Equipment is a long-term asset, and we list the long-term assets after the short-term assets. Here are all your liabilities, total liabilities, common stock, and now that retained earnings, we show that revised new balance, and you can see you're in balance. That ends the adjustments. Our next video will be closing journal entries.